Welcome to the Deep Dive. Our mission is simple. We cut through the noise of earnings calls and financial reports to bring you the key strategic insights, the stuff that actually moves the needle, and ultimately the stock. Today, we're diving into Aon PLC, ticker AON. They reported their Q3 2025 results pre-market back on October 31st, and well, the market definitely noticed.
It certainly did. A definite positive reaction.
So our goal here is to quickly break down those results, figure out what strategic moves are driving this performance, and explore this huge long-term opportunity management kept bringing up on the call.
Yeah, and just starting off, the overall tone was very constructive. This wasn't just scraping by. It was a really solid quarter across the board. So let's hit those headline numbers first. Adjusted earnings per share, the EPS, came in at $3.05.
Okay, $3.05, and the consensus was what, around 2.91 cents?
Exactly, 2.91 cents. That's a little over 14 cents. Pretty substantial, and it represents 12% growth compared to last year.
Wow, okay. A nearly 5% beat on the bottom line for a company this size. That definitely signals strong execution. What about revenue?
Revenue landed at $4 billion, which was just a bit ahead of the $3.96 billion consensus. So a slight beat there, too.
Right, but it sounds like the quality of the growth is maybe the bigger story.
Absolutely.
Yeah.
Organic revenue growth was strong, 7% year over year. And importantly, this wasn't just one segment carrying the load. It was, really broad-based. Every solution line grew 5% or better.
Consistency, yeah. That's key.
And maybe even more compelling, they did this while expanding margins significantly. The adjusted operating margin widened by 170 basis points.
170 BTS, okay, up to 26.3%.
Yeah. Getting that kind of revenue growth and margin expansion at the same time, that's the goal, isn't it? It really suggests the core strategy is working.
Okay, let's definitely unpack that, because 7% organic growth plus 170 basis points of margin expansion, that doesn't just happen. What are the specific levers they're pulling? Is it cost cutting, tech, some kind of reorganization?
Well, management points pretty directly to two things. The execution of their Aon United 3x3 plan, which is their overall strategic framework, and critically, the scale benefits they're getting from something called Aon Business Services, or ABS.
ABS, right. Sounds a bit like corporate jargon, no offense. What does Aon Business Services actually do that helps expand margins by 170 basis points? How does it work?
No, fair question. Think of ABS as their, global shared infrastructure. It's about standardizing processes that are common across different regions and business lines, things like HR, finance, accounting, but also, crucially, their data and analytics platforms.
So it's not just about saving on paper clips, then?
Definitely not. It's about creating global consistency. So when they develop a client solution in one area, it can be deployed faster and more efficiently elsewhere with less duplication of effort. That consistency creates operating leverage. As revenue scales up, the associated costs scale up slower. That's really what drove a big chunk of that margin improvement.
Okay, that makes sense. Leverage through standardization and shared platforms.
And the CEO tied this directly to their main strategic pushes, scaling up their analytics capabilities firm-wide, really focusing on expanding in the middle market segment, and also being proactive in, as they put it, unlocking new sources of capital for clients, especially for complex risks.
And you mentioned cost discipline. We saw some concrete numbers on restructuring, right? Something like $35 million in savings this quarter. Does $35 million really move the needle on a $4 billion revenue base?
It actually does, especially when you look at the trend. That $35 million alone contributed about 90 basis points to that 170 BPS margin expansion in Q3.
Ah, okay. So more than half the margin beat from restructuring.
Well, it contributed about half of the total expansion amount. But yeah, a very significant contribution. And they're on track for $150 million in savings for the full year 2025. The bigger picture is they're aiming for a $350 million annual run rate of savings by 2026.
$350 million. Okay, so this is a sustained multi-year effort, not just a one-quarter fix.
Exactly. It's about structurally streamlining the business enabled by that ABS platform we talked about.
All right, this is why I think it gets really interesting, especially for anyone looking at long-term growth. That 7% organic number, how much of that is just Aon riding a wave of higher insurance prices versus them actually, winning business and taking share?
Yeah, great question. And the answer seems pretty clear. This is mostly an execution story. They break out the net market impact, that's the effect of general insurance rate changes and client exposure growth. That contributed just over 1 percentage point to growth.
Only 1 point out of 7.
Right. So if total organic is 7% and the market tailwind is only about 1%, the other 6% or so is coming from Aon's own efforts. Alpha, essentially.
Wow. And how are they generating that?
New business generation was, frankly, phenomenal this quarter. It added 11 percentage points to organic growth.
11 points, that's huge. Where did that come from?
It was pretty evenly split between getting more business from their existing clients, expanding the relationship, and winning completely new clients. And they're fueling this by hiring. Their net revenue generating headcount is up 6% so far this year.
Investing in people to drive growth.
Precisely. They even quantified it, saying the 2024 hiring class alone is expected to add something like 30 to 35 basis points to the full year organic growth number.
That focus on internal execution, winning business, hiring talent, it really paints a picture of a sustainable growth engine, doesn't it?
It does. It gives you more confidence. It's not just a cyclical upswing.
Okay, let's pivot slightly. Talk about the different business segments, maybe the balance sheet moves. How did the performance look across their main divisions?
Yeah, pretty consistent, actually. Commercial risk is their biggest unit, the traditional corporate P&C insurance brokerage. That brought in about $1.99 billion in revenue and grew 7% organically.
What drove that?
They highlighted double-digit growth in their core U.S. P&C business. Part of that was strong demand related to M&A activity, clients needing transaction liability insurance and that sort of thing. And construction was another big one. Specifically, they called out demand from data center construction projects. We'll come back to that.
Okay, data centers. Got it. What about reinsurance? That can be a volatile area. Property rates have been softening a bit, haven't they?
They have, but reinsurance still delivered strong growth, 8% organically. This was driven by both treaty placements, those are the big portfolio deals, and facultative, which is placing individual complex risks.
So how did they manage 8% growth if property rates are easing?
Well, while the rate increases might be slowing down, clients are often buying higher limits, needing more coverage. Plus, Aon emphasized the strength of their analytics arm within reinsurance, the Strategy and Technology Group, or STG.
STG, yeah.
Yeah, STG helps clients model really complex risks, like climate or cyber on a portfolio basis, and then find capital for those risks, sometimes from non-traditional sources. That analytical edge keeps them essential, even when basic market pricing softens.
Makes sense. Differentiated by analytics. And health solutions, that was around 6-7% growth. What's the angle there with healthcare costs being such a huge issue?
It's increasingly about using data analytics to tackle those rising costs. The CEO specifically mentioned the challenge of new, expensive drugs like the GLP-1s, the weight loss and diabetes medications everyone's talking about.
Right. Those are having a huge impact on employer health plans.
Exactly. So Aon was using its data platform to help clients understand that impact, manage those specific high-cost exposures, and optimize their overall health and benefits programs. It's moving beyond just placing benefits to actively advising on cost management using data.
Okay, interesting. Now, before we get to that big macro theme you hinted at, there was a major portfolio move too, right? The sale of the NFT wealth business?
That's right. A significant move. They agreed to sell the majority of the wealth management business they acquired with NFP to a private equity firm, Madison Dearborn, for about $2.7 billion.
$2.7 billion. What does that signal strategically?
It signals a real sharpening of focus. They're doubling down on their core risk, retirement, and health brokerage and consulting businesses, the high-margin, analytics-driven stuff. They want to be an intellectual capital firm, not necessarily a broad financial supermarket.
And that cash infusion.
Yeah, it significantly strengthens the balance sheet. You see that reflected in their cash flow. Free cash flow jumped 13% year over year to $1.08 billion in the quarter.
Okay, strong free cash flow generation. That discipline makes sense.
Absolutely. It shows the profitability and efficiency of the core model, especially after shedding a less core, potentially lower margin business.
All right, so that sets the stage. Strong quarter, good execution, disciplined portfolio moves. But management spent a lot of time on the call talking about something much bigger, a massive long-term trend.
They really did. It dominated a good portion of the prepared remarks in Q&A. The big theme is the absolutely enormous boom in data center construction being driven by AI and cloud computing.
We hear about AI everywhere, but they put some numbers on this, right?
Huge numbers. They estimate the required capital expenditure, the CapEx, just for building out these data centers globally will exceed $2 trillion over the next several years.
$2 trillion, just let that sink in. That's like the annual GDP of Canada or Italy, just for data centers.
Exactly. It's a staggering amount of investment. And Aon's angle is all that construction, all that high-value equipment, all those operational complexities, they all need insurance. They estimate this wave could create over $10 billion in new insurance premium volume just in 2026 alone.
$10 billion in new premium for the industry in 1 year from one source. That's transformative. So if Aon can capture a decent slice of that.
It absolutely changes their growth trajectory, and they're not just sitting back waiting for brokers to call them. They're actively positioning themselves now to be the go-to solution provider for this specialized risk.
How are they doing that? It sounds like standard insurance might not cut it.
It often doesn't. These projects are incredibly complex, so Aon launched a proprietary multi-line insurance program specifically called the Data Center Lifecycle Insurance Program.
Okay, what does that cover?
It's designed to bundle the different finances and risks together. You've got massive construction risk, you've got marine cargo risk for shipping billions in sophisticated chips and servers, you've got cyber risk once it's operational, business interruption, property damage. It's a unique and concentrated set of exposures.
So a specialized bundled solution requiring serious analytics to underwrite and place.
Precisely. And they emphasize this isn't just a plan on paper. They gave a concrete example.
Oh, yeah.
They mentioned they recently placed nearly $30 billion with a B in total coverage for one single client, a top global hyperscaler, for their data center development program.
$30 billion in coverage for one client's data centers, that proves they are executing on this right now at serious scale.
Exactly. It shows they have the capability and the market access to handle these mega risks, covering both the building phase and the ongoing operations.
Okay, you combine that long-term vision with the strong Q3 results. It's no wonder management sounded confident.
Very confident. They reaffirmed their full year 2025 guidance, which was already pretty positive.
Yeah.
Mid-single digit or better organic growth, 80 to 90 basis points of margin expansion for the full year, and double-digit growth in adjusted EPS and free cash flow.
And the market bought it. The stock reaction reflected that confidence.
It did. Closing up nearly 4% on heavy volume that day. Investors clearly like the clean beat, the margin story, and especially this massive data center catalyst narrative.
All right, that leads us perfectly into our final segment, time for trade ideas. Just a reminder, this is purely theoretical, maybe a little provocative, based only on what we've discussed from the call, absolutely not financial advice.
Okay, so playing off that central theme, the data center build-out and Aon's unique position. A theoretical trade idea could be a pair trade. Go long Aon and short, let's say, a basket of more traditional generalist property insurance carriers.
Long Aon, short property capacity. Interesting. Why the short side against property insurers? Don't data centers need property insurance?
They absolutely do, but the scale and complexity are the key. That $2 trillion wave of construction requires immense, highly specialized underwriting capacity. Your average regional P&C carrier, or even a larger generalist without Aon's sophisticated analytics, without their SDG capabilities or their access to alternative capital markets, might really struggle to effectively underwrite or provide the sheer amount of capacity needed for these mega projects.
So it's a capacity mismatch argument.
Exactly. Aon, with its specialized programs like the Data Center Lifecycle Facility and its analytical edge, is positioning itself as the essential intermediary, the toll collector, facilitating the flow of capital into this specific demanding risk class. They earn fees and build relationships regardless of whether broad market property rates are hard or soft.
While the undifferentiated carriers might struggle.
The bet would be that the sheer scale and specialization required for data centers could cause volatility, underwriting losses, or simply missed growth opportunities for those carriers who lack Aon's specific tools and access. So you're betting on Aon's unique facilitation role while hedging against potential struggles in the broader, less specialized property market trying to absorb this demand.
A fascinating way to potentially play that massive AI infrastructure build-out through the insurance lens, betting on specialization and data against generic capacity. Okay, so to quickly recap the key takeaways from Aon's Q3, a really clean beat and raise driven more by internal execution than just market lift. Margin expansion clearly benefiting from the Aon Business Services platform and that ongoing restructuring discipline. And of course, this huge, compelling long-term growth story centered around the data center and AI infrastructure boom.
And the final thought, maybe the next key thing to watch for you, is about capital allocation. Management's clearly focused on discipline. They mentioned expecting $1 billion in share buyback for the full year 2025. Now they have this $2.7 billion cash infusion coming from the NFP wealth sale.
Right. What do they do with it?
Exactly. How much of that $2.7 billion gets plowed back into more M&A, maybe accelerating their middle market strategy, versus how much just gets returned to shareholders via even more buybacks or maybe dividends in early 2026. That decision will tell us a lot about their priorities heading into next year.
A key variable to keep an eye on. That wraps up our deep dive into Aon's Q3 call. Thanks for joining us, and we'll catch you on the next one.